Best Sense podcast for the first week of February 2026. And it was a reasonably volatile week for markets with tech stocks, especially the big ones in the US, and software companies, to be fair, of all size, on the back foot, both in the US, in Europe, and in Australia. And it really was quite remarkable how good some of the results were. Google, which seems to be winning the AI race amongst its peers, reporting some really very solid results, strong outlook, but also a lot of capex, and down after the result and down a few percent since. Amazon, good results again, but capex and margin worries over the next year in their guidance really put investors on the back foot. And overall, the Nasdaq was down over 5% before rebounding a little bit last Friday. And all of this just shows just how expensive some of these stocks have been, but also relates to some nervousness around a new piece of software put out through Anthropic, whether it's that specifically or whether that is something that's crystallized people's worst fears about just how easy it is going to be for some people to be able to replicate some business models. And there's basically a lot of uncertainty around that. And given that uncertainty, that also translates into uncertainty around the ROI on the capex that some of these majors are doing. It just seems to be moving quite fast. But overall, a lot of the rest of the world actually doing okay. And if you look at it year to date, in local currency terms, especially things like emerging markets, especially Korea, as we mentioned last week, still up by 10%. Small companies up by sort of 5 or 6%, at least in local currency terms, even if the Australian market has been a little bit flat. And bond markets sort of behaving reasonably well, as we've mentioned. However, but if you translate that into Aussie dollar terms, you get a different picture. You can see the Nasdaq is down now by more than 5%, and most markets are in negative territory. And that's because as the Aussie dollar has appreciated, we haven't had this natural cushioning effect, which we often get from our overseas holdings because the Aussie dollar tends to be cyclical. Now, behind that was the RBA's decision, or at least to some extent last week, to raise rates widely expected, which is why that chart that you can see in front of you, if you're watching this, which is expected cash rates, only moved up by a few basis points. But it really did underscore, along with the slightly hawkish tone by Michelle Bullock in the press conference afterwards, and it really underscores the fact that Australia is marching to a slightly different tune with the Bank of England and the ECB remaining on hold, and the potential for rate cuts in the US. It shows that we're going in a different direction, and you can see that the currency here compared to most other major currencies, and we've highlighted the one in US dollars, obviously hitting 70 cents and up by about 5% so far, which is normally what we don't see when markets are being a little bit turbulent. So that's something we've got to look out for. And what it does mean is that, say, for a 70-30 diversified portfolio, which was up almost 2% the first few weeks of the year, is now down sort of level pegging, reasonably flat. And it doesn't matter whether you're active or passive, you've got roughly the same result. So maybe something to watch out for, those currency correlations, a little bit disturbed. Is it a temporary thing? Is it a permanent thing? Just something to watch out for. Something else that we've been looking at is how international equity managers have been navigating these markets. Now, for a long time, there's been the sense that they've been leaning against some of the most expensive stocks out there. So you'd expect, when those expensive stocks fall, for managers to do well. Perhaps not the growth managers, which I've got on the chart here. Now, it's just a bunch of lines, but you can see it's sort of, the index is right up here. I'll just highlight that. So down about 3.5%, and everything else down by sort of between 5 and 15%, depending on how growthy those managers are. If you look at the sort of value equivalent, you get commensurate, well, almost commensurate actually, upside. So some managers up by sort of 6 or 7%, most of them above the index, which is here, sort of down 4%. And there is a sense that there's a rotation trade going on, that because there's nothing really economically that's happened that supports a lot of these value strategies, apart from the fact that US data has been reasonably strong, apart from the employment data. But it might be more an artifact impact of people rotating into those kind of stocks, which is very much what we saw in the early noughties when you had the dot-com breakdown. And it wasn't necessarily during a recession that these stocks were doing particularly well, the value stocks and the smaller stocks. It was that the money that would have gone into the tech stocks was rotating in. So there's maybe a little bit of a sign of that. Now, perhaps the real surprise was some of these core rotational managers. We have another subgroup which includes quality value, things that are sort of a bit in the middle, or they can rotate a little bit. And you would expect these managers potentially to be making hay, especially as they had a pretty torrid year. Last year, you can see here the index up 20%, and most of those up a reasonable sort of 15%, but some of them down sort of 10%, very wide band. So there's been a lot of polarization. There's been a lot of sort of cross-sectional volatility, so a wide range. But all of these managers below the index. And then you would have expected, given that change in that shift in tone, that maybe it would have augured better for those kind of strategies. But that doesn't seem to be the case. You've got the index down 4% here, and most of those strategies still behind. So it is definitely an environment that active fund managers of all stripes are finding quite difficult, apart from those value strategies. Now, the other thing which is interesting, when we look at it in risk-adjusted terms, if you look at the growth managers, they're actually sort of, even the ones that are doing well have actually had more volatility than the index, which is kind of interesting. So people are having to take on a lot of volatility and, struggling to outperform a rising market, which is kind of interesting for those kind of growth strategies. Meanwhile, the complete opposite for the value strategies. We think that that's telling you something about the underlying valuation and the uncertainty around some of those underlying stocks and sector exposures, etc. And what you're getting there is a lot less volatility, and as it happened over the last year, better performance than the index. So maybe there's not just that rotation trade, but maybe there's some valuation underpinning as well. And then with those sort of rotational managers, it was a little bit all over the place, as you'd expect. So for now, that's just a little bit observational, not absolutely sure what to make of that. We're going to talk to a lot of these managers. And it's possible that in the growth space, with a lot of stocks down 20% or so, quite big stocks, maybe there's an opportunity there, but that's where we've got to kick the tires. And with some of those sort of value strategies, maybe you lean into that a little bit. If the market's telling you that, there's not that much uncertainty and, you're seeing that rotation. These are the things that we have to weigh up, and we'll be talking to our clients about in the next few months. And in particular, some of those sort of rotational strategies. What is it that's, why they're getting the worse end of both sides of this shift? Now, one possible explanation is exposure to things like materials. That's been an energy so far this year. Those are quite often sectors that a lot of these managers don't have exposure to, and they have been the best performing so far this year. Which brings us to the Australian market. Obviously, that's been the best performing sector locally, but it has been very difficult, as we mentioned last week, to sort of parse what's going on behind. A lot of factor models not really working very well. Correlations seem to be breaking down all the time. So we thought we'd try something with an AI model, doing some cluster analysis, just to say, look, forget everything that we know, forget these ex-ante risk management models that we use. Just if we observe what's going on over different periods, what kind of clusters appear? And it's actually quite interesting. There's some things which you would expect, things like resources and miners related to China and as a commodity proxy. REITs and banks seem to be clustering together, but interestingly, all but one. So CBA actually more correlated over the last 6-9 months, a lot more correlated with technology stocks. And you can see that in this chart here. Correlation, is it causation? Difficult to say. But there's another thing about this chart which is really interesting, is just over the last week, that supposed correlation completely blew apart, with tech stocks very much on the back foot, down another 10% in some cases, but CBA bouncing by 6%. So the underlying thing there is that you really have to look at the fundamentals. We think in this environment, correlations are very unstable. And that brings us to our What We're Working On video, with Tim Binstead this week, where we talk about exactly that, the focus on the fundamentals, especially going into an earnings season where this could be creating threats. Unstable correlations make risk management very difficult, but it could be creating opportunities as many babies are being thrown out with the bathwater all the time. So if you're interested in that, maybe tune into the video, and otherwise we look forward to talking again next week. Thank you.